Right now, there are two accounts that matter to you, yours and theirs. And every month, money moves from the first one to the second quietly, automatically, without anyone asking if you're okay. You didn't sign a contract. There was no meeting. One day, you were just the one who picked up the phone, and after that, you were the one who paid. Your parents need rent covered, or medication, or the electric bill that got behind, or all three. And you said yes because saying no didn't feel like an option. I've stood on every level of this. Not just the levels of money, the levels of what carrying two lives does to one bank account, one credit score, one person. The banks have opinions about all of it. They won't say it to your face. But they'll say it in your fees, in your limits, in the small moments where the system tells you exactly where you stand. Let me save you 10 years. This is how banks treat you when you're funding your parents' life from the beginning, all the way down to broke. Level 1. You have a job. A real one. Direct deposit benefits the kind of stability that should make you feel solid. But your take-home pay does something strange each month. It arrives and then it leaves not to savings, not to debt, not to anything with your name on it. It moves. You cover your mother's phone bill, your father's insurance gap, the copay that showed up without warning. The bank doesn't see any of that. What the bank sees is this income coming in, no savings accumulating, and a checking balance that resets to near zero every 30 days like clockwork. To the algorithm, you look like someone who can't hold money. Not someone who is holding someone else's life together, just someone who can't hold money. So they treat you accordingly. No upgrade offers. No, you've been pre-approved. The relationship stays transactional deposit spend repeat. No one at the branch asks what the spending pattern means. They just see the pattern, and the pattern says risk. That's the rule at this level. The bank sees your balance, not your burden. There was a specific month. You remember it. Maybe your father's medication cost changed. Maybe your mother's landlord raised the rent. Maybe two things happened in the same 30-day window, and for the first time the numbers didn't clear. You moved money you shouldn't have moved. Or you used a credit card as a bridge just for the month, just this once. That's the month the bank started watching differently. Your utilization, the percentage of your available credit you're using, ticked upward. You didn't notice. Why would you? You were focused on making sure the lights stayed on at a house that isn't yours. But the credit scoring system noticed, and it made a quiet note. Here's what nobody tells you about credit utilization when you're supporting family. The threshold isn't about hardship. The system doesn't have a field for, I'm covering two households. It has a field for balance used versus balance available. And that number started climbing. No one called to ask if you were okay. The score just dropped a few points. And a few points, it turns out, is the difference between a good interest rate and a punishing one when you eventually need to borrow. That's the rule at this level. The system charges you interest on compassion. You set up overdraft protection because life doesn't wait for payday. It felt responsible at the time. A safety net. Something between you and the embarrassing moment at the register. What you didn't fully read, what almost no one reads, is what that protection actually costs. Every time the account dips below zero and the bank covers it, there's a fee. Small enough to feel manageable. Large enough to add up. And when you're running close to the edge every month because a portion of your income is already allocated to someone else's expenses, that edge becomes a recurring address. The bank profits from this. Quietly, reliably. Not because they're targeting you specifically, because the overdraft product is designed for exactly the kind of account that barely breaks even every month. And yours barely breaks even every month. You are their customer, not in the good way, in the dependable fee generator way. I remember being at this level, not knowing whether to feel grateful the payment went through or angry about the $10 it cost to clear. Both at the same time, usually. That's the rule at this level. The bank will catch you and send you the bill for catching you. You need a personal loan, or a line of credit. Something to absorb a larger expense, maybe a medical bill, maybe a repair something that can't be paid in one paycheck. You walk into the branch, or you fill out the form online. And here's where all those quiet months of depleted savings and elevated credit utilization and near zero balances become a very audible answer. The rate they offer you is not the rate in the advertisement. That rate is for someone with a different profile, someone who has been accumulating, not redistributing, someone whose account history tells a story of surplus. Your account tells a story of throughput. Money arrives, money leaves. Repeat. So they offer you a higher rate or a lower limit than you needed, or both. They're not being cruel, they're being consistent. The risk model says you are a higher risk borrower, and higher risk borrowers pay more. The fact that your risk is not recklessness, that it's obligation love duty, is invisible to the model. You accept the terms because you need the money. And now you have a loan at a rate that makes every dollar you borrowed cost more than it should. And the people you borrowed it for don't know that part. That's the rule at this level. Risk is risk, regardless of why you took it. You know you should have an emergency fund. You've read the articles. 3 to 6 months of expenses liquid in a high-yield account. The math is not complicated. But 3 to 6 months of your expenses includes your parents' expenses, which means the target number, the number you'd need to actually feel secure, is not one household's worth. It's 1.5, maybe 2, and that number is so far from where you are that the savings account exists more as a symbol than a strategy. You put in what you can. Something moves the other direction. The balance stays roughly flat. The bank sees a savings account that has been open for years and holds almost nothing. What you see is a savings account that you have filled and drained and refilled and drained in a cycle that never quite resolves, because the variable you can't control keeps changing another bill, another gap, another month, where theirs needed more than yours could spare. The bank's relationship with you at this stage is purely maintenance. You're not a wealth-building client. You're not on anyone's call list. You exist in the system as someone who has accounts but doesn't seem to be doing anything meaningful with them. The meaningful things are just happening somewhere else, somewhere the bank can't see. That's the rule at this level. Invisible sacrifice never shows up on a balance sheet. At some point, the credit card stopped being an emergency tool. It became infrastructure, the thing that bridges the 1st of the month and the 15th when the timing doesn't line up. The thing that covers what comes up when the money is already spoken for. You're paying it down, not all the way usually, enough to keep it functional, enough to stay below the limit. Just enough. The balance carries. Month to month, the number at the bottom of the statement is never zero. It's the same number, more or less, with interest added, and a payment subtracted and new charges replacing the ones you cleared. And here is where the bank is most profitable in your relationship. The revolving balance is the most valuable thing you carry for them. Interest month after month. Compounding on a number that never quite disappears. You are not a defaulted account. You're something better for them, a performing account that never pays off. Reliable minimum payments. Consistent interest. A customer in permanent motion. You didn't design it this way. You designed it to survive the month. But the product was designed knowing people like you. Exist people with obligations that exceed their liquidity, and it is working exactly as intended. That's the rule at this level. The balance that never reaches zero is their most loyal product. Here is the conversation that almost never happens at a bank branch. You sit across from an advisor. They ask about your goals. You talk about saving for retirement, maybe eventually buying a house, building something for yourself. They nod. They run numbers. They show you a chart. And at no point does anyone ask how much of your income is currently going to support family members who are not on this account. Because if they did, if that number entered the conversation, the entire plan would have to be restructured. The savings projections would change. The timeline would change. The definition of what's possible for you right now would change. But that question is not in the script. The product is built for a single household income picture. Your life is not a single household income picture. So you leave with a plan that was designed for someone else's situation, holding it up against a life it was never built to fit. I've sat in that chair, nodding at a plan that looked clean on paper and made no contact with reality. The distance between those two things is where a lot of the silent suffering lives. That's the rule at this level. Financial advice is built for one life. You are living two. Something falls through. Maybe the loan payment is late, not skipped, just late. Maybe the credit card minimum gets missed during a month when everything hit at once. Maybe the bank balance goes negative and stays there long enough for the account to be flagged. And the bank that has been quietly profiting from your situation, that has been charging you fees and interest and offering you nothing you actually needed, that bank becomes very communicative. Suddenly, there are calls, notices, a late fee added to the balance, a note on your credit report. The language shifts from valued customer to a clinical description of an account in arrears. The system that never asked why your savings weren't growing now has a great deal to say about one missed payment. The same model that never credited you for 2 years of supporting 2 households now marks you for 30 days of being human. And the number your credits score the 3-digit summary of how the system sees you drops. Not catastrophically. Not in a way that makes news. Just enough to make the next loan more expensive. The next application harder the next time you need help, slightly more punishing than the last. That's the rule at this level. The system forgives nothing it didn't benefit from. There's a number below which things start to feel different. Not zero. Zero is a number. What you're looking at now is a pattern. The account that was barely above zero is now below it, and the question is no longer, how do I get ahead, but how do I stay functional? At this level, the bank's treatment of you becomes almost impersonal in its efficiency. Overdraft fees compound. The credit limit that was already not enough gets reviewed and reduced because high utilization and missed payments have redrawn the picture the risk model holds of you. Less access exactly when you need more. You call the bank, you explain. Sometimes you reach someone who applies a one-time courtesy waiver. More often you reach a policy. This is the floor, not in a dramatic way. No single catastrophic event brought you here, just months of outflow. Exceeding inflow, the gap between what you earn and what 2 lives cost, slowly expanding until the ground was no longer where you thought it was. And the parents you've been funding, they don't know this part. Or maybe they do, and that makes it quieter, not louder. The money moved without a press release. The toll was paid the same way. That's the rule at this level. The floor arrives slowly and then all at once. Remember the beginning. 2 accounts. Money moving from one to the other, and you somewhere in the middle trying to hold both. Here is what I want you to hear, not as advice, not as a plan, but as the thing no one said to me when I was at the worst of it. The bank's model of you is not you. A risk score is not a life score. A depleted savings account is not a depleted person. A credit report that doesn't ask the right questions has no authority to answer who you are. But you do need to protect yourself. Not instead of your parents alongside them, because the version of you that ends up broke cannot help anyone. The account that empties completely becomes useless to everyone it was meant to serve. That's not cold. That's arithmetic. There are paths from where you are. They don't look like the standard financial advice paths because your situation isn't the standard situation. They look like hard conversations about what you can actually sustain, about what help looks like versus what sacrifice looks like, about finding systems, family agreements, government programs in many states, community resources that can carry some of what you've been carrying alone. The bank will not have this conversation with you. The algorithm has no field for it. But you can have it, with yourself first, then with the people who need to hear it. You are not behind. You are between levels, and the weight you're carrying is real. And the fact that you've held it this long without the system acknowledging, it says something about you that no balance sheet ever will. The next level is not about abandoning anyone. It's about building something strong enough to actually last. You're closer than you think. Now, go stand on it. Asterisk, for educational and storytelling purposes only. Not financial advice. Investing involves risk, including loss of principal. Do your own research or consult a licensed advisor.